Taking a look here, the S&P 500 following the Nasdaq into correction territory on Friday, leaving analysts wondering, is this a routine dip or a sign of something worse to come for markets? Let's bring in Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Brian, is this a sign of things to come?
Well, I think that it actually is a little bit as far as these ups and downs. Oftentimes what happens is you get these market corrections driven by fears over growth, inflation, geopolitics, and then the corrections can turn into bear markets if those fears become reality. We think that we're going to be dipping in and out of these fears for a while here, so just expecting a little bit more volatility. So it's kind of one of those situations from a tactical perspective. We like the idea of, hey, maybe kind of buy the dip, but then sell the rip and just brace yourself for some of this volatility, probably until we get, let's say, into June of 2024, which is maybe the earliest at which the Fed would consider starting to cut rates.
So, Brian, with sentiment being where it is, then there's been obviously a lot of whiplash here, a lot of data for investors to have to contend with, on top of geopolitical concerns as well. How do you see sentiment changing in this period, especially as we have a very full week ahead, including what we'll hear from the Fed this week?
It really is. And so on our investment committee here at Annex, we are kind of looking at the calendar ahead. And really the big news is going to probably be the Treasury refunding announcement coming out Wednesday morning. Yes, the Federal Reserve is meeting on Wednesday, but it's pretty much baked in the cake what they're going to do, which is nothing. Now, the refunding issue, that's a little bit bigger issue as far as the amount of debt that the government is issuing. The Fed has stepped out as being a captive buyer of that debt. Foreign demand has declined, so households and investment funds have had to fill that gap. So if the Treasury comes out and if they are announcing that they're going to be really leaning on longer term issuance, that could be taken as a negative and you could have more of a bond sell-off. So that's probably one of the key drivers of sentiment. Now, thankfully, Treasury Secretary Yellen is absolutely brilliant. She knows this, and that's maybe why she's going to be biased towards issuing things that are more shorter dated, and we could get a bit of a relief rally, not just with bonds, but also with equities, if that is the case.
So, Brian, how do you position yourself in that expectation, particularly around fixed income?
In fixed income, we do like locking in these higher long-term rates. Bonds are very attractive if you can hold them. So when we look across our portfolios, some people, they have to invest through mutual funds. And so you get this mark to market, the ups and the downs. But if you can actually own the individual bonds, we find that to be a little bit more attractive, especially for individuals who are, say, in a higher tax bracket. Municipal bonds, preferred stocks, things like that can actually be a little bit more attractive, and we like to try to lock in those yields. So bonds are attractive if you can hold them as individuals. If it's through these ETFs and mutual funds, it gets a little bit trickier.
And what about equities? Obviously, we've seen a lot of valuations sort of going through the roof here, and of course, fueled by a lot of this generative AI fury here. But then a lot of people wondering, we're in the show and prove phase, especially when we're listening on these earnings calls. What do you like in that space?
Yeah, so we thankfully were positioned in a few of the names that benefited from that initial enthusiasm about artificial intelligence. It seems like it's kind of gone through this progression fairly rapidly about, okay, it's going to be the chip manufacturers, then it's going to be the device manufacturers, and ultimately it's going to be the users who benefit from it. And so the way that we're kind of positioning things is that as some of those valuations got a little bit more nosebleed levels for, say, chips and device manufacturers, to trim that and focus more on the longer term picture about who ultimately will experience those productivity gains. We found it encouraging when Microsoft reported how they said that users of their Copilot, about 40% of Fortune 100 companies who are using it, they experience some rather massive productivity gains. And so it's not necessarily, it's kind of doing this more like second and third round thinking. It's not just about, okay, who's going to make the chips or the devices, but who's going to be utilizing the technology. So when it comes to that, there are a number of names in the healthcare area and in industrials as well that we think could be benefiting from it, where the valuations maybe don't fully reflect those possible productivity gains.
Finally, Brian, roughly 80% of companies that have reported earnings so far posting beats. Your big takeaway so far in the season?
Yeah, so far so good, but really those big beats haven't been enough to really drive the entire market higher. We don't have this environment where it's a rising tide lifting all boats. Also, people are really hyper vigilant about watching the guidance. It's not just about what have you done for me lately in terms of third quarter, but what's coming down the pipeline in terms of fourth quarter and beyond. I think Facebook is a good example, or sorry, Meta is a good example of that. The numbers themselves were pretty good, but then actually on the call with the guidance that they gave, it was a little bit more sobering. And as a result, the stock reacted more to that. So it's really more about that guidance than it is about what they've done for us lately.
Will certainly be a packed week of earnings to look forward to. Vic, thank you there to Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Thank you so much.
Thank you.